Hello and welcome to another episode of Connecting the Dollars. Today we are going to discuss the current economy. We are currently in the first couple weeks of the second quarter. And with me today, I have Danielle Woods and David Vaught, who are the other co-owners of Propel Financial Advisors, along with Amanda and I. But before we get into the actual discussion about the market and how things are affecting our clients and their portfolios, we're going to just do a little introduction about the experience that Danielle and David has. It extends for many years, and they've seen many ups and downs and strange things in the market. So we've talked about on our podcast a lot about where you get your information from and how you know it's a good source. So Danielle, why don't we kick it to you? Danielle Woods is an attorney and a financial advisor, co-owner of Propel Financial Advisors, as I said. What's been your experience leading up to now that helps you form your opinions and your thoughts on how to kind of navigate what we're going through?
Okay, thanks. I've been doing this. This will be 27 years in September that I've been working with clients on financial advising and tax. Started before that with law school, where I focused on state and probate tax and securities law, and I've been working with David. David hired me almost 27 years ago, and so I've kind of learned everything that can happen. When I started in this industry, it was right before the dot-com bubble burst. And then we went through what they call the lost decade in the first 2000s, followed by the delightful drop in mortgages in 2008. And since then, the big things have been the COVID period from 2020 to 2022. And now we're dealing with this economic just unknown that's having a big impact on clients. And through that, I think it's been helpful. I don't have the economic theory background that David does, so we'll let him talk on that. I've really dealt from it a lot more from a practical perspective, dealing specifically with clients on their personal finances, small businesses, and tax concerns. So Emily and I also co-own a tax firm. We just did our 10th season, and every year it's something new.
Yep.
So this is not the rapid amount of changes is not what's unusual. It's just the cause, which always changes.
Yep.
Yeah.
All right. And David, do you want to talk a little bit about your experience and how that helps you navigate the economy and what you talk about or what you discuss with clients when we're going through different times of economic change?
I think Danielle and I both had a similar experience because we've worked in investment management for about the same amount of time. I think for me it's 29 years, but instead of 27. But I've also been on some leaves of absence. Before we started the investment firm. I worked for the Illinois Treasurer for 4 years, served on the investment policy committee, got a lot of experience in the bond market and in cash management. But also because I was working in a financial area, I could qualify to enroll in and get the designation of chartered financial analyst. And they have a 3-year program of study and test taking, and then later I went down and helped them grade the exams of later applicants into that program. So it gave me a lot of background in theory and practice
Mhm.
of financial analysis. Uh, Specifically as it relates to the problems in the bond market today, I did do a few years as the governor's office of director of the governor's office of management budget in Illinois, and that was during a financial crisis, the Great Recession. It was called. It was the mortgage-backed crisis. It had tremendous effect on the fiscal situation of the state of Illinois and other states in the country as well. We're in a similar kind of financial conundrum today, where there's concern in the bond market on U.S. Treasuries that the international investors may not want to buy them as much as they have in the past. There's concern that changes in the value of the dollar may affect that. What I learned dealing with Moody's and rating agencies, who I had to go speak and ask questions in front of potential investors groups. They would do it when you're issuing $1 billion in bonds and want people to buy them. Lots of people come to the meeting, from mutual funds and insurance companies, bond buyers that are very experienced at this. What became clear to me, even though we were in a crisis and we had some of the worst financial conditions of any state in the country at the time, physical conditions, the rate is what's important. If you're still standing, and literally, and you think you may have some doubt if people really will buy your bonds in the open market, the rate is so important. As the rate goes up, the buyers show up. And that's actually what's happening today in the U.S. Treasury market. In the fear, the rate is going up to get the buyers to bid solidly. And that's a normal function. What I like about that, in terms of investors that are concerned about all this uncertainty, that's a normal functioning market. That's the way the markets function. When the markets are normally functioning as opposed to collapsing into total chaos, that's a huge difference. And that's happening both in the stock market, even though it's volatile, and in the bond market. So I think that's an important experience that justifies our view. And in practice, are actually going through with clients 2 or 3 of these similar crises, going all the way back to the dot-com bubble. Staying the course and not losing your mind is a fundamental thing to do, because the markets deal with this. It'll change values of things.
Mhm.
It'll change the attractiveness of different kinds of securities. But the functioning market is why we're able to invest and benefit from that.
Okay. So it sounds like you have a somewhat positive outlook on, I mean, positive may be too strong, but like you
It's
have
not
a
positive, and it's just reassuring.
reassuring. Yeah, that's the better word
In
that
a
I would
crisis,
like to use.
in a crisis with clients, or we're trying to. We were doing a huge capital program when I was a director of Office of Management Budget in Illinois. We were trying to sell $10 billion worth of state bonds in a financial crisis, and states can't print money.
Yeah.
But they have to deal with rating agencies, but they can issue debt for capital purposes. And seeing that actually function, working with the Goldman Sachs and Citibank and others, and with all the major insurance companies that were coming to buy them, or mutual fund companies like PIMCO who bought our bonds. You see how the market functions. You see how they react. You see how they're afraid. You see their fear, and then you see their response.
Yeah.
Another 50 basis points on interest, we'll be happy.
Gotcha.
That's a functioning market, even in a lot of controversy and fear.
Yes. I find that reassuring. So
Yeah.
like what you've seen is what is happening currently, and that is a reassuring thing for sure.
Yeah.
And so Danielle, if you want to chime in, how does that kind of, I mean, I know you've been getting a lot of questions from clients. How does the current outlook in the economy affect how you are changing or not changing current clients' portfolios?
Well, as a team, which is how we work and how we make decisions, we work together as a group to kind of come up with where do we think things are going, and is it time to take gains? Is it time to reallocate? And how that looks in practicality on a client's portfolio, it differs from client to client. We don't have models. We don't plug everybody into model 1, model 2, model 3. Those of us who trade for a client account talk to clients, and we make decisions based on that client. So there is no one response. It depends very much on the client's age, their risk tolerance, their outlook. And when I say risk tolerance, that doesn't mean that we just go along with whatever the client says, because the definition of risk varies from person to person as well. We get clients who come to us with a portfolio and say, I'm very risk averse. And they show up with a portfolio of 15 stocks. That is not a risk adverse portfolio. That's very aggressive. So, a lot of times when clients are talking, oftentimes it's from, obviously they only have their own perspective. People aren't coming to us who are professionals at this. They only know their own stuff. And so we have to ask a lot of questions. We listen to what they say and kind of send it back to them. Like, well, you said you're risk adverse. What does that mean to you? You said you want to retire at this age, but what does that look like? It's all very subjective and it's very client specific. So when it comes to whenever the market is doing what it's doing, whether you are in agreement with why it's happening, or you're not, or you voted for the person, or you didn't vote for this party, and you're blaming somebody else. There's a lot of the political, emotional response that goes on, which is called noise. And we always say that it's our job to work away from the noise and to try to quiet the noise for the client. Um, and that can be hard to do. We're people too. We have our own personal portfolios, we have our own personal belief systems, and we have to set those aside. And so when a client is calling panicking because you manage their entire life savings, we take that seriously, and we don't want to make rapid decisions. So last fall, when the election was coming and we weren't really sure where things were going to land, as a team, we said, well, it's probably time to take some gains. We had this huge run up in 2023. The market was hyper focused on tech. And we said, long term, is that necessarily where we want to be? And we agreed that it wasn't. And we took some ways of kind of spreading the portfolio out and diversifying it. We also just took some gains in the stock market and moved more to fixed income, because when you don't know what's going to happen, you need some safety. You need a safety net. And you can talk in percentages all day long. Well, this portfolio is 20% bonds or 30% bonds, but there's also a dollar factor that becomes much more important as a client ages and their retirement account is looking much more like a more current need for income versus a long-term investment. So, you could say, well, this client is 20% bonds and that's enough, but if their portfolio is only 300,000, 20% is only 60 grand. That's going to cover a year.
Mhm.
So we have to start making those decisions on a one-on-one basis. So when clients have called me in the last few weeks or texted or called, I've had some tears.
Mhm.
Um, as a financial advisor, we have to say that there have been just pretty horrible things that have happened to people's portfolios over the years, whether it's COVID or the mortgage crisis, and you feel helpless and you feel out of control and you don't know what to do. But even when you don't know what to do, you're doing something. You're making a choice to kind of set still. And even the economists that we listen to call this a wait and see market. Like it's moving every day. I think the other day Amanda and I were talking about whether or not to take gains in something, and I was like, quite frankly, we can't trade fast enough. I mean, it's physically impossible to, number one, know where to go or not go and get there. I mean, it's a manual process for us. And so part of our response has been, we prepared these portfolios for this sort of thing, maybe not for the reason that we're seeing, but we know that markets drop and they climb, and then that's what they do. They've always done that. This volatility is not unusual. We've been looking at volatility like this, I would argue, since 2008. I don't know if David feels the same way, but we have never traded this much in my entire career. Um, and so we try very much to be nimble and to be thoughtful and to keep our clients' ideas of what they're investing in the forefront, and not focusing so much on what's going to happen next week or even 3 months from now. It's, in 10 years or 20 years or 30 years, when this client needs this money, are we staying the course to the point where we're going to be able to continue to compound money and make more of it and take gains where they are and invest when the market is low, when it makes sense? Those strategies never change.
Right. Yeah. And
I think Danielle makes an important point though, because the markets are really good at giving you feedback. A lot of times it's not the feedback you want to hear, right? But they're really good at getting the feedback. When markets are moving in a very volatile way, the feedback gets very confusing, because the market will be up one day a whole lot and down a whole lot the next day. Which feedback do you want to respond to? And that's why the wait and see attitude. We hear that from economists. We hear that from serious investors. That are very good people that we followed for a long period of time and know that they have a lot of good sound advice and insight into things. It's unsettling, to get too much feedback in a short period of time. So wait and see makes a lot of sense. And Danielle's point about gradual moves that are adjusted to client needs makes a lot of sense. I think that's fundamentally two of the things we're trying to do the most.
yeah. And I think that comfort comes from, maybe comfort again is not the right word, but just as
Reassurance?
the
Reassurance?
reassurance,
That's our
stick with
new
that
word,
one.
reassurance.
The reassurance, I mean, it comes from the fact that, you know, as investors and as financial advisors, we've been through this multiple times. And even though it's been for different reasons that there's been this market volatility or these, times of uncertainty, you kind of adjust as you go and stay the course with your personal portfolio. So that's kind of, again, one of the things we talk about a lot on this podcast is having the accountability and having someone to kind of work through these times of uncertainty. Like, so having that sounding board in us as financial advisors to help you kind of quell the fear and just talk through things really helps during these uncertain times.
Mhm.
So,
I also wanted to add,
yes.
I think sometimes when bad things happen, the clients think, well, what are you going to do about it? And I'm a problem solver. That's just my personality. And sometimes the response is to do nothing. It might look like you're doing nothing, but you are. Or um, there are always positives. There are always opportunities in the market. Now, we're not dealing with multi-gazillion, private portfolios or anything, but so for me, when, the first drops kind of started a couple weeks ago, the very first thing I thought of was who can do a Roth conversion? Nvidia was down 17% in one day. So if a client held the stock of Nvidia or some other, banks were really low. JP Morgan was down a lot, 8, 9%. Those were the things that I moved over. And, the market has still come down. And I know that's, yeah, did I get it on the bottom? No, but we don't know where the bottom is until it's late, but you still got a good deal on it. So when you move an asset that is temporarily depressed to a portfolio that doesn't pay taxes, that rebound, because I have yet to see anything in my entire career that can rebound like Nvidia. It's insane. When it finally rebounds, it's rebounding for free. So there are positives, and I always try to find them. Like, hey, have you made your Roth contribution yet this year? This is a great time to buy stocks right now, for the long term, not because, I had a client call and say, well, I think I want to make money on tech for the next 9 months. And I was like, I'm not doing that for you. Like, I don't trade tech stocks for a 9-month window. I don't consider that safe. And maybe it'll go great and
Yeah,
maybe it won't, but I can't take that risk for you.
right.
So there's always opportunities. And we, as a group, always say, okay, what do you want to do today? What do you think? Where do we see that negative? How can we turn it into a positive? And so we're always looking for that.
Yeah.
I'll give another example. Danielle's talking about things you see that create opportunity. If you're an international investor, as opposed to a domestic investor in the U.S. stock market, for the last decade or so, you've been pretty disappointed. The U.S. market has outperformed the international world, and you see that as an imbalance. But when's it ever going to change, right? Well, it's changing, and the catalyst for it is the weakness of the dollar right now. The dollar is very weak because of some of these,
Policy
tariff
decisions.
and other concerns
Hmm.
about change. That makes the international stocks much more attractive, and so that's just essentially kind of a no-brainer if you're underinvested in in the international stock market, and you can move over there. When it's cheap now, because all the markets are cheaper, I will say. Um, that 9 or so percent, I believe the dollar has moved. Um, that creates a profit in the international markets. So there are lots of things like that that are happening that are potential. They may be transitory. They may go away, but we're looking for those kinds of opportunities and others
Yeah. Yeah.
because we have to be forward focused, not looking back and go, "Oh my God,
Hmm.
awful."
But
Uh,
our
that
looking back serves us. I remember in 2008, people were freaked out, and there were people who got out of the stock market and never went back in. And I had a client say, well, how much did I actually lose over the last 5 years? And that particular client, the tune was $100,000 they lost
Yeah.
by freaking out, getting out of the market and going to bonds, which at the time were paying nothing. And even the bonds that are paying 4% now, which is a nice yield, inflation is still at what, 2.8? You're not getting anything. You can't make up enough over time. So if you're selling at the bottom as an emotional response to the market, what I always tell people is, why is the market down? That's the difference. We might, as advisors, sell out of a particular security or particular mutual fund when it's down, but that's only because we're moving it to where we think it's going to rebound better.
Right.
And we've done a good job with that. Remember in 2008, we did that specifically and we were on the money and it did great. We don't always make the right decision with everything, but there's always something you can do besides just get entirely out of the stock market and go to the bond market and wait until you think the right time is to get back in the equity market. Nobody knows what that is. It's always in your rear view. And so this time when clients call and go, oh my God, the US stock market is falling apart. We need to get out. I'm like, why is it falling apart? Is it because the companies overnight suddenly became so much worth less than they were this morning? No, it's an emotional response to something that's happening temporarily. It's
Right.
always temporary. It has always been temporary. And so does it make sense to just abandon it, or does it make sense to move from this particular security to another one because we think when the rebound happens, that's where it will be? That's the point. That's the
Right.
doing that you're doing. Rather than just immediately reacting emotionally to a market move. You
Right.
have to understand why it's happening. And that's why we constantly recommend listen to economists, ask questions, stop listening to politicians. Quite frankly, half of what they say is BS.
Yep.
So don't listen to them. Listen
Or
to the
more,
smart people. Pardon?
or more, Danielle.
Probably, I'm being nice, but
Yeah.
they're not the people who have devoted their entire lives in education and have an academic interest in this. The people who work in jobs like David used to have, who work for governments and who work to, it's not about how do I keep my job or how do I screw these people or how do I make it better for these people? It's
Mhm.
they really are very data driven and they want this system to work properly and they will do what it takes to do that. And it might not be a popular thing to say. It doesn't look exciting, but they are doing their jobs. Let them do their jobs.
Yep. And kind of what you both have said over the course of this talk is that your underlying philosophy hasn't changed. You're still doing the same thing you're doing that you've done, over the whole 27 to 29 years. We'll figure out what number it actually is. And the reassurance, actually, the positivity, and I know that's maybe a little strong, but I do feel like this listening to this conversation can make people feel more reassured about the stock market.
Mhm.
Danielle saying when the rebound happens, not if the rebound happens. So you we've seen a lot. They've seen
Yeah.
way more
I
than
mean,
I have.
my suggestion
And
is always rather than panic, find a way to productively respond to what you're dealing with.
yeah,
Um, you know, I don't know how else to put it. That's what you
yeah,
pay us to do, and we can't,
exactly.
that's what we have to do.
That's what we're
And
here
I've
for.
heard of advisors who have told their client, I know of a professional advisors who have told their clients, get out of the stock market completely and go to bonds. And I had a client who called the other day and, well, this guy said that, the powers that be are manipulating the market so that they can buy everything really cheap and they're hoping we'll all sell everything. Should we sell everything? I was like, you just kind of argued against exactly what you said. If you think that they're doing this to make a lot of money, why would you get out? Chances are you're going to make a lot of money too. It's the same market. They're
Mhm.
buying the same securities you are. Um, so, people will talk themselves out of things sometimes, I think.
Yeah.
And I think it's helpful to just talk it out. I do that a lot. I call it financial counseling, where we
Yes,
just like take your panic and your emotions and try to set them aside so that you can think more clearly.
exactly. Yep. And I think we should wrap it up here. Thank you so much for all of the information that you provided with us today for our audience. And if anyone has any questions, you can reach out to info@connectingthedollars.com. We could always get you in touch with David or Danielle or any of us to, schedule a call if you are someone who is nervous about the stock market and needs a little bit of a counseling session as it is. So thank you both for your time, and we'll talk to you soon.
All right. Thank
You
you.
took my
Thank
paper,
you.
Emily. So did we all.